No, it's not working. So you're still at A16Z.
Halftime, yeah. Yeah.
Enjoying it?
Yeah. No, and actually it's been great for research, to be honest. So,
That's right.
yeah.
Okay, no microphone.
Oh, is Tim gonna have a microphone?
You are connected to a microphone.
That should be good, yeah.
Good.
So, hello everyone. I'm very happy to welcome Tim. I try not to use much time. Tim wanted to start at 10 to 5 and go until 6:15 or 10 to 4 and 6:15, so he wants all his time. A lot of you know Tim. If some of you are graduate students here in Algorithmic Game Theory, maybe you went to Mike's class where we went for a whole semester through your book on game theory. So he's known from his books. He is a professor at Columbia and actually has a startup on...
No, it's not a startup.
Oh,
It's the biggest VC
16Z.
firm in the world.
Okay, he's working at 16Z, and so it's not a startup. I think of everything crypto as a startup.
It's not crypto.
Oh, it's not crypto either. Okay, I'm really sort of bad at this. Okay, I stick sort of with the more CS side of things, okay? So Tim has, I know him since a long time, he has many prizes. He has a ACM Grace Hopper Award, he has the Kalai Prize, the INFORMS Lanchester Prize, the Gödel Prize, just to name a few of them. He's a fellow of many societies, obviously the ACM, sort of importance to us here, the Game Theory Society and the Advancement Society for Advancement in Economic Theory. He's also a Guggenheim Foundation fellow, and and as I said, he has written many books, among them this book on game theory, and he will tell us about the computer in the sky today.
All right. Thank you, Christian. Thanks. Can you hear me okay? Sounds okay, great. So great to be back at UC Berkeley. I kind of have a long history here. I was a postdoc with Christos Papadimitriou now. Hate to say it, over 20 years ago. Been here many times. Always great to be back. Lots of longtime friends. Had a really fun day so far. What I want to talk about today is kind of some computing functionality, some technology I think would be really cool to build. And I want to talk about some of the scientific and engineering challenges that come up when you try to actually build it. For an analogy, you could imagine 60 years ago, maybe someone had a vision of a technology that would enable any two people anywhere on the globe to communicate digitally, pretty much instantaneously. You can view today's internet as some kind of approximate realization of that vision. And what I want to talk about is, in some sense, if we think of the internet as global shared infrastructure for communication, so for disseminating zeros and ones all over the globe, I want to talk about the analog for computation. So global shared infrastructure, not just for disseminating zeros and ones, but also doing processing of zeros and ones, okay, general purpose computation. So the functionality I want to think about building out is really just that of a computer that in effect will have hardware, like a processor, memory, its own states. I promise originally I thought I was going to put an image here, and then I decided it was much funnier if I just left it like this, actually, yeah, so, okay. But it's going to be a very unusual computer, much different than this laptop, for example. I want the computer to have no owner, no operator, no one with root access, okay? In effect, we can think of it as like running in the sky, where we can all just observe its computations. I want it to be as robust as the internet, as hard to shut down, okay? As hard to interfere with its functionality, so we can be very confident in its computations. And I really want it, like the internet, to be open access, where anyone can use it. Okay, and here we're talking about a computer. So when I say use, I really mean two things. First of all, users can install new software on this computer to be run by its operating system. And secondly, you can interact with the computer, interact with its operating system or with other programs, smart contracts if you like, that other users have installed, okay? So, most of you have probably guessed, this computer is not going to correspond to a physical machine. Okay, a physical machine has an on-off switch, it has an owner, someone can just turn it off. It's going to be a virtual machine. There will be physical machines, possibly scattered all over the globe, communicating with each other over the internet. And these physical computers will run a protocol, a blockchain protocol, which will enable them to coordinate in a simulation of what's logically a single shared virtual machine. Right, for an analogy, right, web servers, those are physical machines scattered all over the world. They, in effect, cooperate to give us the experience of the virtual web that we all know to interact with. The point of a blockchain protocol is to allow physical computers to simulate this virtual machine that we then all have the opportunity to interact with. Okay, so fundamentally, as far as I'm concerned, a blockchain protocol is really the operating system of a shared virtual machine. That's how I want you to think about it, okay? Given the time, I really want to focus on the computer science challenges that come up in building this technology. I will say very little about applications in the talk itself. Feel free to ask me Q&A or offline. The one thing I will say is, for a room like this, a room of engineers and computer scientists, I hope just kind of the idea of like global shared infrastructure for computation sounds like it should be pretty powerful, right? Getting that infrastructure for communication has been a pretty big deal. If you also add general computing functionality on top of it, seems like that should be good for something. That's the most general answer as far as applications. At the other extreme, one point I just want to make quickly, you hear many people equate blockchain technology specifically with cryptocurrencies and payments. And in my opinion, that is like equating the internet with email, okay? We all use email, or like the older ones among us, all use email every day, okay? It's very valuable. It's a big part of how we use the internet, but we all know the internet is a general technology and email is one very specific thing you can do with it, okay? In exactly the same way, blockchain technology is a general technology. Cryptocurrencies and payments are one specific, possibly very important, but very specific thing you can do with the technology. Okay? That's all I have time to say about applications. So I really want to talk about 3 threads of my work over the past few years, quite different, actually, in nature. I've optimized the talk for breadth over depth, so as a consequence, I'll do all of these with a very light touch. If you want to go in deep, there's sort of videos on my YouTube channel that go through all of these topics in a lot more depth, okay? 2 themes I do want you to look out for as we go through these. So first of all, the surprisingly, perhaps, multidisciplinary nature that arises when you try to build out this technology. And I say that as someone who's always aspired to interdisciplinary work, usually between computer science and economics. But the tool set needed to get this stuff to work properly, I mean, I've never seen anything like it. It uses many different parts of computer science, many of which have historically had nothing to do with each other, different parts of economics that have historically had nothing to do with each other, other fields, and also political science and others. We'll only see a couple of these today, but just, all of this is sort of are skills that are needed to actually make this technology the best version of itself. The second thing I want you to look out for as a theme is that I'm not sure I've ever seen the pipeline from really just kind of theoretical work to practical impact be as short as it is in this area at this moment in time. And I'll try to give you glimpses of that as we go along. So first, I want to talk about transaction fee mechanisms. Okay, so what is that? That's a particular component of a blockchain protocol. For this part of the talk, you don't need to know much about how blockchain protocols work to understand the problem. So fundamentally, think of a blockchain protocol as being responsible for just maintaining an ever-increasing sequence of transactions. What's a transaction? Think of a transaction as a snippet of assembly language code. Remember, it's simulating a virtual machine. A transaction is a snippet of assembly language code to be executed in that virtual machine, okay? Transactions get added to this running log in batches. Those are the blocks in blockchain, okay? So a batch is just a bunch of transactions. What's important for us is that these blocks are only added every so often, and they can only be so big. Specifically in the Ethereum blockchain protocol, which I'll use as a running example for reasons that will become obvious, you add a new block every 12 seconds. A typical block might have, say, 200 transactions in it, okay? So you do the math, it's what, 15, 16 transactions per second. If that sounds like it's not very much, that's because it's not very much, okay? So because the processing power of, say, Ethereum and also Bitcoin is quite primitive, and because they're quite widely used, relatively speaking, demand for processing in the virtual machine is much, much bigger than supply. In other words, many more than 15 transactions per second would be happy to have the privilege of being executed in that virtual machine. What that means is that a blockchain protocol has no choice but to pick winners and losers. Okay, users are submitting transactions. Some of them are going to get executed, some of them aren't. Okay? The job of the transaction fee mechanism is decide who gets in and who doesn't, and then what should the winners pay for the privilege of transaction execution. Okay? So that's a transaction fee mechanism. What might it look like? Let me tell you about the first price auction, which is the transaction fee mechanism that's been used in Bitcoin in its entire 16-year existence. It's also what was used in Ethereum up until about 3 years ago. Very natural. The blockchain protocol, right, it's just this piece of software. It can't magically know which transactions are more or less valuable. So you ask users to put their money where their mouth is. When you submit a transaction to one of these blockchain protocols, you submit a bid that you'd be willing to pay should your transaction be included for execution, okay? Now, in the way most blockchain protocols work, including Bitcoin and Ethereum, a block is added by one of the physical machines running the blockchain protocol, sampled at random. Okay? If you want, think of it as sampled uniformly. If you know about proof of work or proof of stake, you know it's a little bit more complicated, but whatever. One of the physical machines is chosen at random, and that machine is designated as the dictator to assemble the next block, to choose the next 200 transactions. So if you, as a user, submit a transaction, you include a bid. If someone includes it in their block, your bid gets transferred to the person who actually included you. Okay? That's a first price auction. Users attach bids. They pay their bid upon transaction inclusion to the block producer that included it. Okay? So this is a reasonable mechanism. It's worked decently in practice. But if you've taken even one lecture in auction theory, you know that one of the issues with a first price auction is that it's pretty hard actually to figure out how to bid in them. Okay? We've known this, I don't know, for decades and decades. Okay? Why? Well, the problem is, like, if you're willing to pay, let's say, up to $10 maximum, if your indifference point for transaction inclusion is $10, you definitely want to bid less than that, right? You want to shade your bid so that, you know, if it's included, you get some positive value out of it. How much do you shade? $9.50, $9, $8.50? Depends on the strength of your competition. So that's something you have to reason about when you're thinking about how to bid in a first price auction.
Is that the current price?
Of a transaction in Ethereum? Well, so it depends on the transaction. I'd say for the simplest possible transaction, I haven't looked lately. If I had to guess, I guess it's a few bucks. Okay. There are also, just to be clear, I mean, there are also, there's ways to have much cheaper fees as well if you use so-called layer 2 blockchains, which ultimately settle to layer 1. So you can have it for a few pennies as well, okay, if you do a different sort of workflow. That's actually one really nice thing that's happened over the past 2 or 3 years, is there's now actually really, there's ways for kind of regular end users to get transactions processed basically with Ethereum security guarantees for pennies rather than from dollars. So that's been some nice progress that's happened in the last 2 to 3 years. Great question, thank you. And it's not just an academic problem, okay? So this is a screenshot of a wallet. Wallet is the software that you typically use as an end user that sort of mediates your interactions with the blockchain protocol. So you'll say to your wallet what you want to accomplish, and then the wallet will actually prepare the transactions to send to the blockchain protocol. So this MetaMask is one of the most popular Ethereum wallets. This is a screenshot from 2020. And it's trying to give you advice. It's trying to help you out. Okay? It's trying to suggest what you might want to bid. This is when transaction fees were a lot higher. Okay? And so it gives you a menu, right, a range of options depending on how much you care about latency. And anyone who used Ethereum back in those days, 2020, early 2021, would have this, you know, even though really smart people work at MetaMask, they try to use past bidding data to give you good estimates, they'd screw up sometimes, right? Maybe they'd miss the fact that there was a sudden demand shock, for example. So sometimes they'd screw up and they'd tell you to pay way more than you needed to, right? And so you'd get in immediately, but you'd overpay. Sometimes they'd give you bad advice and tell you to bid lower than you needed to, and then you'd really be screwed. Then your transaction just wouldn't be included, right? Because you bid too low given the competition. So this was actually really annoying. This was making Ethereum kind of harder to use than it needed to be. So a natural mechanism design question is like, why are we using these first price auctions, right? Why don't we do something smarter? Like hopefully most of you have heard about a second price auction, also known as a Victory auction. So this is where the winner pays not their bid, but the highest bid by somebody else. So the second highest bid overall. Second price auctions have this magic truthfulness property, which is you don't have to reason about the competition at all. You don't care if there's 10 other people bidding or 100 other people bidding or 1,000 other people bidding, you don't care. You just bid your maximum willingness to pay, say at $10. The auction will sort of optimally shade your bid after the fact on your behalf, okay? So the question would be like, why don't we just switch to something akin to a second price auction? Okay? Or in general, why don't we do something better than a first price auction, more incentive compatible? Okay? So hopefully that sounds like a basic question, right? These blockchain protocols need to decide who gets in, who gets out, what are they priced? In the case of Ethereum, at the time I was doing this work, which was 2020, it was also a very urgent and timely question. Up to that point, so Ethereum launched in 2015, and they sort of copied Bitcoin originally. They were running a first price auction. That was the incumbent transaction fee mechanism, but in 2020, there was a challenger, okay, known as EIP 1559, which I'll tell you about in just a second, okay? And Ethereum prides itself on its sort of strong community, kind of modeled after sort of open source software, so sort of consensus driven, big discussions among all the community stakeholders before making major changes. And in 2020, opinion was split over sticking with the incumbent, the first price auction, or switching to the challenger, EIP 1559. So in that spirit, Tim Byko, so again, this was in 2020, he's sort of a major figure in that community, and he did a community survey. So he reached out to stakeholders, said, how do you feel about this newfangled transaction fee mechanism? And if you don't like it, is there anything we as a community could do to make you feel better about possibly making the switch? People mentioned a lot of things, but what I want to highlight is one of the most common responses was people were nervous due to the lack of a formal specification or proof for the mechanism that people can independently evaluate and critique. And let me emphasize, not a single respondent of this survey is the type of person who writes academic research papers. These were all people who really dearly cared about the success of the Ethereum project. There are people who write wallet software, people who run exchanges, people who run the physical infrastructure that runs the blockchain protocol. Those were the type of people responding. And among this group in the Ethereum trenches was a visceral hunger for the kind of analysis that I and other people in my research communities do. And that was certainly a very strong driver to spending several months of my life in 2020 doing the work I'm going to talk briefly about. Next, you might say, is this a hard problem, right? Okay, yeah, block space is scarce, like not everyone can have it, like you want to pack it with the most valuable ones. Like, can we copy paste something out of like chapter 2 of some textbook, some mechanism design textbook? And as so often happens, right, when you really get into the idiosyncrasies of an application domain, you find that there are extra constraints or just other stuff that is not modeled in the textbook that you had in mind, okay? And you have to revisit the problem in some sense from first principles. So I wrote a whole blog post about all the reasons why mechanism design in a blockchain context is harder than in most traditional economic applications. Just to give you one sense, you're probably wondering, like, why don't we just run like a second price auction, right? What's the problem? All right, so what would that actually mean? Okay, so there's a block, there's 200 transactions in it. So let's say by a second price style auction, let's say we mean that everybody who gets included in the block pays the same thing, which is just the lowest bid of an included transaction, right? So if the highest bid is $100 and the lowest bid of someone who got included is $10, everybody pays $10, okay? Well, now imagine you're one of these block producers. So remember how transactions get added, right? We sample one of the physical machines uniformly at random, and they have unilateral control over the 200 transactions that they include. And now suppose like 199 transactions are willing to pay a really high number. Okay, but the 200th one is only willing to pay a really low number. Well, why don't I could just like make up my own 200th transaction with also a really high transaction, with also a really high bid, put that in at the end and make everybody pay a really large amount, okay? So the point is I'm not going to actually respect what I'm supposed to be, the second price auction that you want me to run. Okay, and that's not the kind of thing that comes up when you're talking about like the US government, running spectrum auctions, something like that, okay? And that's the reason why you almost never hear about second price auctions in a blockchain context, is the easy manipulation by, in this case, shill bidding. Back to the Ethereum story, right? We talked about the incumbent, first price auctions. Let's talk about the challenger, EIP 1559. I did not design this mechanism. This was designed by Vitalik Buterin, who's also the lead founder of the Ethereum protocol. I would say there's sort of 3 main changes that were proposed in EIP 1559, okay? Change number 1, use a reserve price. Okay, the aspiration here is to be what's known as a posted price mechanism. What does that mean? Well, when you're shopping on Amazon, you go, maybe you want to buy a book, it's 40 bucks. It's very simple cognitively. Like you're like, is it worth 40 bucks or not? Take it or leave it. Okay, so ultimately we'd sort of like, transaction inclusion to be a take it or leave it offer. That's what we're aspiring toward. So there's going to be a reserve price, which you should think of as attempting to be a posted price. So it's gonna be like $5, and so that means like to be eligible for inclusion, you need to bid at least $5. That's what the reserve price means. Interestingly, because of some issues with collusion, any money raised by the base fee, by the reserve price, is not going to be passed on to the block producer, but instead will actually be burned. Meaning the cryptocurrency used to pay the reserve price will actually be coins removed forever from circulation. Okay, and that's essential for some of the game theoretic guarantees of this mechanism. Okay? So that's the first big idea. Reserve price revenues get burned. What's the reserve price going to be? It's just a piece of software. How's it supposed to know? $5, $10, $15? How's it supposed to know? Ideally, if demand was high, the price is going to be high. If demand is low, the price is going to be low. How's the protocol supposed to know if demand is high or low? Okay? Change number 2. Rather than having a hard cap of 200 transactions per block. We're going to make it a soft cap. Okay? Aspire to 200 transactions on average. And let's still, for safety, have a hard cap, but let's say 400 transactions. So you can go to double the target if you want, but we're aiming for 200 transactions every 12 seconds. Now, you can use past block sizes as a signal to feed into your local search algorithm to search for the right reserve price. Last block had 300 transactions. Guess we're pricing it too cheaply. Let's raise the reserve price a little bit. Last block had only 100 transactions. Guess it's too expensive. Let's lower it a little bit. Okay, so that's what it does. It does local search, searching for a magical reserve price at which exactly 200 people are willing to pay it, adjusting accordingly if the last block size was above or below 200. Notice, crucially using this idiosyncrasy of the blockchain setting that you have one of these auctions every 12 seconds and every auction's outcome is public. Okay, so that gets fed into the next iteration of the auction. Okay. Idea number 3, there's basically an emergency backup first price auction. So as a user, you always have to pay the reserve price. Optionally, you can pay extra, more than that. Anything you pay extra actually does get passed on to the block producer like bids do in a first price auction. So this just allows you to kind of try to coax the block producer into giving you special treatment if that's something you want, okay? So what's the upshot? So my job was to compare the incumbent and the challenger. First price auction, EIP 1559. The upshot is that according to my analysis, the challenger actually is a Pareto improvement over the incumbent. EIP 1559 is a Pareto improvement in terms of incentive compatibility over first price auctions. Has all the advantages of a first price auction plus more, okay? All right, so let's start with the baseline. Let's give some grades to a first price auction. Good news is, unlike the second price auction, right, where remember, sort of as a block producer, I don't even want to, like, I'm not going to respect your wishes for me to run the second price auction. I'm going to do fake bids, I'm going to show bids, all this stuff. First price auction, there's kind of nothing I can do to manipulate it, right? It's like, if I include someone, they're going to pay their bid. There's nothing I can do to make it sort of higher or lower. Okay, so not manipulable in the way the second price auctions are. It also has some collusion resistance properties that I'm not going to get into, but which are quite nice. As we discussed, first price auction, definitely not truthful. You always want to shade your bid. That makes it hard for users to figure out how they should bid. EIP 1559, it still has these same pros. Okay, so again, because of the posted price flavor of it, it is also not manipulable by block producers. And because it turns out, this isn't obvious, but it turns out because of the burning of the reserve price revenues, that gives you the same collusion resilience of first price auctions. Moreover, most of the time, meaning outside of an edge case, actually this is just a posted price mechanism. Really, a user shows up and it's just $5 for inclusion. If you pay it, you're in. If you don't pay it, you're out. Most of the time, that is the experience of a user. It's just a posted price mechanism. Now, caveat, it's not perfect. There is an edge case. If, for some reason, local search has totally failed and has come up with a reserve price that is way too low meaning more than 400 transactions are willing to pay it. Remember, we're shooting for only 200 transactions to be willing to pay the reserve price. If it's so low that actually more than 400 are willing to pay it, well, now there's not room for everybody, and the users are back to where they were before, having to compete for inclusion through their tips, the way they had to compete before for inclusion through their bids, okay? So if the reserve price is way too low, you lose truthfulness. Theorem, that is the only edge case in which you lose truthfulness. Okay, so almost all the time you do have the posted price property, okay? Obviously, you'd like to get rid of the edge case. Turns out you can move it around. But a recent result with Hao Chung and Elaine Shi from Carnegie Mellon says actually you need to have edge cases no matter what. Okay, you can't get everything you want all of the time. In that sense, EIP 1559 is actually on the Pareto frontier of what you can achieve for this problem. Okay? All right, so that work was done in 2020. Happy ending. Fast forward to August 2021, Ethereum did in fact have a big protocol upgrade where they switched the transaction fee mechanism to EIP 1559. So today, the biggest smart contract platform in existence, Ethereum, this is how they do transaction pricing, what I just showed you, okay? I'm not claiming like they wouldn't have done it had I not done my analysis. Hard to know. Anecdotally, many people have told me my report was very important for sort of getting more community support. But in any case, they did. The one thing I can tell you is they did adopt it 8 months later, okay? And so my report was sort of the standard reference, sort of in the mainstream crypto media, explaining what to expect from this upgrade, okay? Next, I want to talk about squarely blockchain protocols. Okay, and the achievable properties. This is going to be based on joint work with Eric Budish and Andy Lewis-Pai, one of whom is a mathematician, one of whom is an economist. Your first thought would be, oh, the economist has got to be the guy who works at London School of Economics. But then your second and better thought would be, nope, it's got to be the guy with the tie. Eric Budish, so, and then Andy's a mathematician. So I want to talk about blockchain protocols. Let me remind you the picture I want you to have in your mind. Okay, so what is a blockchain protocol? It is software that physical machines run so that they can cooperate in a joint simulation of what is logically a single virtual machine. Okay, it is the operating system of a global shared virtual machine. Okay, so I want to talk about properties that these blockchain protocols, that we want them to have, and then what is fundamentally achievable. Okay, this is a problem of consensus. A bunch of physical machines, you want to keep them in sync. And consensus is an old computer science problem. Beautiful problem, lots of brilliant work done, 1980s and ever since. The minimal requirements you would want of any consensus protocol is liveness, which in our context means as long as users are submitting transactions, the virtual machine should keep doing stuff, should keep executing transactions. And consistency, which means that the physical machines running the protocol should all stay in sync. They should have the same opinion about the current state of the virtual machine. So what can never happen, so a consistency violation, what can never happen is that one physical machine thinks that Alice owns some digital asset, and some other physical machine thinks Bob owns that same digital asset. That is the epic fail that we need to avoid. That is a consistency violation, okay? So what makes this a hard problem? What are the challenges? Okay, so here are the two traditional obstacles that people set up, okay, which are very practical obstacles. First thing is that maybe some of the physical nodes aren't doing what they're supposed to be doing for whatever reason, either out of incompetence or out of malice, okay? If none of the physical machines are doing what they're supposed to be doing, obviously you're not going to have any guarantees. So there's going to be some assumption, some lower bound on the fraction of physical machines that are running your protocol competently and correctly, okay? The threshold depends on sort of the setting, but for concreteness, think of it as like 50%. Okay, so maybe as long as a majority of them run the protocol as intended, you have good properties, and if a majority of them sort of deviate in some way, you don't have those properties. Okay. Second challenge is, the internet can be unreliable. All right, so it may or may not be delivering messages in a timely way. If the internet never delivers messages at all, you're not going to have liveness, for example. So here you aspire toward minimal assumptions about the communication network under which you can get guaranteed consistency and liveness. Okay? And in the 20th century, sort of fundamental possibility and impossibility results mapped out exactly when you can and cannot get these under different assumptions on these two types of challenges. Somewhat miraculously, most of the big blockchain protocols like Bitcoin and Ethereum actually solve an even harder version of this problem that I'll bet most people in the 20th century thought just sort of wouldn't be possible, which is permissionless consensus. What does that mean? Well, any of us right after this talk could go download software and start being one of the physical machines running the Bitcoin protocol. Say, we could do that right now, okay? Even though the Bitcoin protocol has already been running for 16 years and has no idea who we are, okay? And that was not like an aspiration of 20th century consensus protocols. So that's what I mean by permissionless. You allow free entry and exits into the set of physical machines that are running the blockchain protocol, okay? For permissionless consensus, you get a new set of additional challenges above and beyond what we had before. Let me just highlight one, which is the challenge of Sybils. So as I said, we could go download sort of some software and join the Bitcoin protocol right now. We could also download it 10 times and join 10 times under different names. No one would know, okay? So what that means is if you want a blockchain protocol, permissionless one with good properties, it better be robust to this so-called Sybil attack. Okay, the number of identifiers you use better be irrelevant. So if you've ever heard of proof of work or proof of stake, this is where that comes in. This is a way to be Sybil resistant. And so the idea here is you want one of those physical machines control over the protocol, for example, the weight of its vote, to be independent of how many identifiers it uses and to depend instead on some costly resource, the amount of some costly resource that it owns. In the case of proof of work, that costly resource is computational power. In the case of proof of stake, that costly resource is cryptocurrency. The protocol's native cryptocurrency, okay? All right, so that's a quick crash course on consensus, 20th century version and permissionless version. The question I want to ask, can we actually get a blockchain protocol to do something we would not generally ask of a software system, right? So like, if there's an attack on the internet and like a bunch of stuff goes down, like we don't ask the internet itself to fix it, right? Like a bunch of humans like mobilize and like it takes a lot of work to get it sort of back up and running, okay? And that's sort of normal for software systems. I want to actually ask the question, like, can a blockchain protocol actually programmatically fight back with no human in the loop against an attack, okay? Is that possible? By an attack here, I mean a consistency violation. So imagine that some bad actor actually assembled 51% of the resources and actually created a situation where two different physical machines disagreed about the owner of a digital asset. Okay, that's what I mean by an attack or a consistency violation. Now, if you were talking about a proof of work protocol, I don't even know what this would mean. So if someone's assembled 51% of the computational power, this protocol is just software. Like, what's it supposed to do? Like, reach this imaginary arm out and like take people's computers away from them? Like, what does that even mean? But imagine it's a proof of stake protocol. Okay? So imagine someone's control over the protocol is governed by how much native cryptocurrency they've locked up in a smart contract, which, now that you think about it, is actually sort of controlled by the blockchain protocol itself. Now maybe, even though it's just software, it can actually somehow fight back and confiscate someone's power, confiscate their stake. And for a decade plus, this has been sort of a vision, a hopeful vision of something one could do with proof-of-stake blockchain protocols. Ethereum, famously, in an event known as the merge, switched from proof-of-work to proof-of-stake in 2022. If you look at their official documentation that exists right now, possibly the primary motivation that they did this was to have greater crypto-economic security, meaning it's more expensive for an attacker to carry out to cause one of these consistency violations, okay? And until this work, actually, there's no foundations for whether or not that was true. And for example, under what assumptions that might be true. There was intuition. There were some blog posts, right? Blog posts that made a reasonable case, right? But there was really no formal theoretical analysis. And that's sort of the point of this paper. So someone says, and this was widely believed, you know, I think in the Ethereum community and more broadly, proof of stake is more crypto-economically secure than proof of work, okay? How would we assess that statement? Right? What does it even mean to say protocol A is more economically secure than protocol B? How would you prove it? How would you falsify it? Okay? So we need a definition. So the first thing we do is we offer a definition. Okay, so we define a new property of protocols which we call EAC. EAC stands for expensive to attack in the absence of collapse. The collapse here refers to a collapse in the cryptocurrency price. So you would like an attacker to be costly even if the cryptocurrency price doesn't change. The exact definition is annoying. Okay, look at the paper if you really want to, but I encourage you to use this informal notion, which is sufficient for today. A protocol is EAC if, first of all, whenever someone successfully attacks, whenever someone creates a consistency violation, the attacker is guaranteed to lose some of their stake, okay? Guaranteed to be economically punished. Second of all, no matter what happens, if you run the protocol as intended, you will never lose any stake. You will never be slashed accidentally, okay? Bad guys automatically harmed, good guys guaranteed to not be harmed. That's what I mean by an EAC protocol, okay? This is our formalization of the vision of slashing. Our notion of being more economically secure. If you have one protocol which is EAC and another one which is not, we will interpret the first one as more economically secure than the second, okay? So can you have protocols with the EAC property, and if so, under what conditions? So again, I'm gonna have to just be very light touch I can't talk about this in much detail. I will drill down on the bottom result a little bit. The results of this paper you can kind of think of in terms of this lattice. Here's how to interpret it. Again, there's a lot of words here, don't worry about the words. The takeaway from this slide is we're going to vary the assumptions. We're going to vary the assumptions, for example, on the reliability of the network. We're going to have the weakest assumptions on top, and then we're going to make the assumptions stronger as we go to the bottom of the slide. So we're expecting to go from sort of impossibility results to possibility results as we make stronger and stronger assumptions. And so this paper, the point is that it determines this dotted horizontal line, which is the threshold of when you flip from being unable to achieve that EAC property, unable to getting that kind of cryptographic security, flipping to being able to achieve that property, okay? So that's sort of the high level picture. I want you to have a little bit stronger sense, so I'm gonna double click on this result at the bottom, show you what I mean by this positive result, okay? All right. So this is the positive results. This is under relatively strong assumptions. We're going to assume the communication network is relatively reliable. There's another assumption which just says that players don't sort of randomly turn off their machines for no reason in the middle of the protocol. They stay online throughout. And let me tell you how to interpret this line here, okay? So what we're going to do is we're going to parameterize, there's going to be a proof of stake protocol. We're going to parameterize by the fraction of the stake which is controlled by the attacker, okay? So at the left, we have a powerless attacker that has no stake at all. Presumably everything's fine. We're not worried about consistency violations. At the right, we have an attacker that controls literally all of the stake. Presumably there's nothing that we can do. They basically just have unilateral control over the blockchain protocol at that point, okay? What we get is an interesting double phase transition, okay? The first phase transition was known from the 20th century. Okay, this was figured out by the classical work in the 80s and 90s, which is if you design your blockchain protocol well, and the attacker has less than a third of the stake, you have no problems at all. It will never be the case that two physical machines disagree about anything. Okay, they'll always agree on, for example, the owner of all digital assets. There's no need to punish anybody because nobody can do anything bad. Okay, so that's the classical consensus security guarantee. Less than a third, you can't have consistency violations. We've also always known that above a third, you can have consistency violations. This 2/3 threshold, this is new to our work, okay? To the rights of 2/3, like we said, if an attacker has 100% of the stake, presumably there's nothing you can do. Turns out that if they have 67% or more of the stake, there's nothing that you can do. They basically completely control the blockchain protocol. They can certainly cause consistency violations, and they can prevent you from doing anything about it, okay? What's interesting is this middle regime, between a third and 2/3. In the middle regime, the attacker is powerful enough to be able to cause a consistency violation, but not powerful enough, if you design your protocol properly, not powerful enough to escape punishment, okay? So up until this point, you will never see a consistency violation. Okay? It's just literally impossible. Up until this point, you might expect to never see a consistency violation because it's so economically costly for the attacker. So classical security up to a third, and then our definition of cryptoeconomic security up to 2/3, okay?
So punishable, you always mean if I gain $2, you will punish me by at least $2.1.
Good question. Yeah. So, so in the protocol, what happens is that you will lose this much stake. Okay. So you will lose 1/3 of the total stake. So if you controlled 66%, it'll drop you to 33%. If you controlled, just barely over a third, it'll drop you to basically 0. That's the guarantee that you get. Yeah. All right. So the.
So I still make money. If I own 50%, you punish me a little, but I still make something by being there.
But you lose.
Yeah, you lose. So I mean, what's unmodeled here is like what benefit do you get off chain from creating the consistency violation? But the point is like even if you manage to double spend the Lamborghini, that's going to be about like 1% of the sort of cost of the stake that you lose, at least in today's Ethereum, given that there's so much ETH staked. Okay? So there's a number of interesting implications of this work, proof of stake protocol design generally, but also Ethereum specifically. I mentioned the merge in 2022 when I said Ethereum switched from proof of work to proof of stake. They actually made a bunch of changes. I'd say the two biggest ones was that switch. Plus, they switched from a longest chain protocol to using more kind of voting-based techniques from 20th century protocols. So both big changes to the protocol. Our first impossibility result, which I didn't really get to tell you about, but our first impossibility result says both of those changes were necessary to get provable slashing guarantees. Neither one in isolation would have been enough. Okay? If they'd stayed proof of work, you can't have provable slashing guarantees. That's fairly intuitive. But actually also, if they'd switched to proof of stake but stayed longest chain, our work shows you couldn't have gotten provable slashing guarantees. You needed to make both of those big changes at the same time. Our second impossibility result, which again I didn't really tell you about, but an implication of it is one of the things that's really annoying about most proof of stake protocols has to be annoying. What's annoying is they have long cooldown periods. Okay? So suppose you wanted to contribute to running, say, Ethereum or some other proof of stake protocol. You would put some cryptocurrency in escrow. Okay? You would not be able to use it during that time, but you'd be able to like vote on stuff, okay, in the protocol. So suppose at some point you got to pay rent. Okay? You issue a transaction. You say, hey, I need my cryptocurrency back so I can pay rent. There will be a cooldown period where on the one hand, you have no control over the protocol, but on the other hand, the protocol still has control over your stake. Okay, that's the cooldown period. And that's on the order of days. And our second impossibility result actually says it needs to be on the order of days. If you make it shorter, you will not have provable slashing guarantees. Okay? The positive result, I think the interpretation is clear. For a decade plus, the promise of proof of stake has been provable slashing guarantees. We show that with a properly designed protocol, that promise can actually be realized under suitable assumptions. All right, so this got a lot of discussion in the Ethereum community as we were hoping. But what surprised me a lot more was an email I got maybe 6 weeks after we posted the paper, an email from the Federal Reserve Board. So, when they talk about like cutting sort of interest rates, like this is them, like this is the Fed, right? And I was a little bit surprised when they told me they had a, technological research team. Maybe I shouldn't have been, but that just sort of never occurred to me. But I can tell you I was definitely shocked. This paper, this is like 45 pages, 30 pages of which are proofs. Several of our staff read your paper, and we really want to talk to you about it at greater length. So we had a nice conversation with the Fed maybe a few months ago. It's pretty wild. This didn't used to happen to me previously. So, all right. Lastly, I want to talk briefly about some of the work I've been doing in DeFi, or decentralized finance. So here, Jason Milionis is a Ph.D. student of mine at Columbia. Siamak Molemi is in the Business School at Columbia. Anthony Lee Zhang's in the Business School at University of Chicago. Okay? And I want to talk about a concept known as LVR, or lever. All right? So at the very beginning, I talked a little bit. Actually, I didn't talk about it. But so anyways, one of the things that blockchain technology holds great promise for is narrowing the gap in the property rights we enjoy for our physical possessions and things we buy or create in the digital realm. Okay? And once you have property rights, you actually can have things like markets and exchange, okay? So one of the most basic things you might want to do with digital assets is exchange one for another. Like most simply, maybe you want to exchange some cryptocurrency like ETH, Ethereum's native currency, for a digital representation of a dollar, so a stable coin like USDC, okay? And you look at this and again, like I think the natural reaction is like, this is a solved problem. Right? Like, what do you want to do here? Like, any of us who manage a stock portfolio, we kind of do this stuff all the time, right? You buy or sell shares of a stock for digital representations of a dollar. And when you do that, usually the mechanism is something known as a limit order book, right? There's a bunch of standing buy orders, a bunch of sell orders. When they cross, you match, et cetera. And limit order books has not been the dominant paradigm for exchange on blockchain protocols, okay? And it's been sort of for two reasons. The first reason may go away as the technology advances, we'll see, but older blockchain protocols like Ethereum, we talked about how their processing power is primitive. And with respect to that primitive processing power, limit order books are actually fairly computationally expensive. You have to remember this really long list potentially of sort of standing orders. You have to have this matching logic to sort of figure out whether you should clear a trade. The second reason I don't think is going to go away, which is that whether in traditional finance or decentralized finance, limit order books do really well in what are called thick markets. Markets where you have lots of buyers, lots of sellers. Why? You need a counterparty. You want to buy, you need someone to sell to. In a thin market where you don't have a lot of people engaging, it may be difficult to find a counterparty, okay? So, and a lot of, ETH USDC, that would be a thick market, but a lot of other things people want to do exchange for digital assets are pretty thin. So for both of those reasons, what is the dominant paradigm is what's known as an automated market maker, or an AMM, okay? So an AMM is just a smart contract. It's just a computer program, run by a platform like, say Ethereum. And it's basically just always open for business. So it's just going to quote you a spot price, like $3,000 per ETH. And it's willing to take either side of a trade at the spot price. Okay, so it'll buy at the margin at 3,000 or sell at the margin at 3,000, okay? Cool. So now you don't have to find a counterparty, right? The AMM itself will always act as your counterparty, right? So that's why it's really good for thin assets. Now, I said this is just like some smart contract. So you should be thinking like, why does this random computer program like have a whole bunch of cryptocurrency to like let people trade with? Like, where'd that come from, okay? Well, there are these parties known as liquidity providers, or LPs, and they deposit their digital assets into one of these AMMs to enable people to trade. Why would they do that? Well, they earn a share of the trading fees. So it's a way to earn yield on digital assets, okay? All right, I tell you that, and now you're like, okay, but wait a minute, then why would I not actually want to deposit my digital assets into one of these AMMs, okay? And the price of business of market making, and this is true in traditional sort of markets, it's true in sort of DeFi, is something known as adverse selection, okay? Right, and this is true, like we see this in real life, right? So, I don't know, maybe you're sort of like selling your old iPhone to somebody, right? And you think you're sort of being pretty aggressive, you're like, give me $300 for this. And if they just say sort of like, yeah, then you kind of like, oh, wait a minute, shoot, did they know something that I don't know? Does this have some like special camera that I overlooked or something, right? So like whenever someone takes a deal, you always should be worried that because that they might be more informed than you and therefore you're taking the wrong side of a trade. That is adverse selection, okay? It can arise for a lot of reasons, but man, if you're talking about AMMs on a blockchain protocol, it's definitely going to arise. Because what do we say about Ethereum? One new batch of transactions added every 12 seconds. So there was a 12-second period where the state of Ethereum's virtual machine, including the spot price of all its AMMs, where the entire state of the virtual machine is frozen in time for 12 seconds. And 12 seconds is a long time when you're talking about asset pricing, right? If you watch the price of, say, ETH on a centralized exchange like Coinbase, it can move sometimes a lot in 12 seconds. Maybe it goes up a lot, for example. And now, if you're the first lucky person who gets to interact with the AMM, once Ethereum sort of wakes up again 12 seconds later, you could now buy ETH from the AMM at the stale spot price and go around and flip it back on Coinbase for a higher price, pocketing the profit as arbitrage. The arbitrage profit comes at the expense of the liquidity providers. They are playing a zero-sum game, okay? So that is adverse selection in the context of on-chain, blockchain AMMs, okay? So the business of providing liquidity, the business of LPing, it's a cost-benefit analysis. Benefit, you get to share the trading fees. Cost, you suffer these adverse selection costs. So you want to compare these two quantities. Fees, easy to think about, okay, right? It's really just some percentage, right? The some volume and the pool charges some fee on that and you get some share on that. Believe it or not, before this work, no one had a clear way of thinking about those adverse selection costs, the cost part of the cost-benefit analysis. So that is what we proposed. Okay, that is a concept we call lever, LVR. That stands for loss versus rebalancing. Super simple. I'll give you kind of a data-driven definition on this slide. I'll give you sort of the more interesting mathematical definition on the next slide. You just say, look, let's just do the following thought experiment. Look, I deposited sort of my coins in this AMM. It had to be the counterparty for anybody who wanted to trade with it, like all these arbitrageurs. So I was in effect forced to trade my coins at the AMM spot price. Thought experiment, what if I made exactly those same trades, but rather than doing it at the spot price the AMM made me do it, I did it on the open market at a fair price. How much better off would I have been? Okay? That's what this says. Suppose there were N trades, AI is the quantity, could be positive or negative. So like how much ETH I sold, for example. QI is the AMM spot price, PI is the open market price. For example, if I had to sell stuff at a price that was less than the open market price, that's a positive contribution to lever. Okay, same thing if I have to buy at a price which is high relative to the open market price. So lever just accumulates trade by trade, and this is how you isolate the adverse selection cost borne by an LP, okay? So again, this is a simple formula. You can take this to data. I suspect there's sort of MBA students sort of right now sort of calculating this in sort of spreadsheets, sort of very easy, using sort of all of the data we have about AMM prices. More interesting, at least mathematically more interesting, would be like, well, that's fine for like forensics on what I did before, but like what am I gonna do like in 2025, right? Should I actually deposit my digital assets in one of these AMMs? Is that a good idea or is that a bad idea? So I need to reason about what I think that cost and benefit is going to be, okay? Now on the cost side, in order to reason about that, notice lever is gonna depend on the sequence of prices, sort of how the asset price moves. Okay, if it never moves, no arbitrage opportunities, no problem. Okay, not gonna be any adverse selection. If PI is jumping around all over the place, that's when I'm worried there might be a lot of arbitrage, I might suffer a lot of losses. So I need a model of price movement to reason about sort of future lever. And you know, this is all sort of uncharted territory, so we're kind of like, well, what would we do other than the most standard sort of model of asset pricing, like in this context? We just look at the standard Black-Scholes model, okay, geometric Brownian motion. If you've seen this, great. If you haven't seen it, don't worry about it. Think of it as like a random walk in like log price space. The one important thing maybe to know is that there's like one really important parameter in the most basic Black-Scholes model, which is the volatility of the risky asset. So for us, like ETH, sigma. If sigma is 0, price never moves. If sigma is big, it's jumping around all over the place. Okay, so that's the meaning of sigma. It's like the step size of that random walk in log space, in price space. Okay, so the theorem, the main theorem of this result is a formula, closed form formula for lever. Now it's got to depend on stuff. It's not just going to be like 4, right? It's going to depend on sigma. Again, if sigma is 0, no arbitrage, lever should be 0. Sigma is big, lots of arbitrage, lever should be high. If you think about it, it's going to depend on the AMM, actually. So different choices of an AMM will induce different Qs. Remember, Q is the AMM spot price. Okay, so it's going to depend on this. And actually, that also induces A. If you think about like what is the trade size that an arbitrageur would do, it's going to be whatever corrects the AMM spot price over to the corresponding market price. Okay, so the choice of the AMM will determine Q, and therefore A. Okay, so here's the result. Okay, so eye of the beholder, whether this is clean or not, but let me try to convince you this is about the simplest thing you could have possibly hoped for, okay, as far as what the lever is, all right? So remember, lever accumulates trade by trade. We've moved to this continuous time model, so the price is always moving, so there's always arbitrage to be done. So that's why now instead of a sum over n trades, we see this integral from 0 to the time horizon. So lever accumulates instantaneously. Okay, so the instantaneous lever, little l, That's given by the expression minus 1/2 quantity sigma ps squared dx by dp. So what does this mean? So ps, that's just the current price of the risky asset. We knew this had to depend on sigma. There it is on the volatility. It's increasing in sigma as we expected. Unfortunately, it's sigma squared, which is kind of a bummer. But it's pretty high. It depends on the AMM, but only locally, okay? It depends only in terms of the marginal liquidity of the AMM at the current price. So if the price on the open market changes a little bit, this is the volume that has to be traded to correct the spot price of the AMM. Okay? If I had a little more time, I could actually convince you this is really just like the area of a suitable triangle. Okay, so this is even kind of maybe simpler than it looks like on the slide.
And if you had more time, you could explain to us why it was sigma squared.
Why it was sigma squared? No, I wouldn't say it's obvious. It's because basically there's two sides of a triangle, and you just got to figure out the length of them, basically. Okay. Yeah. So, well, yeah.
I'll get another explanation.
Exactly. Yeah. No. I don't have a one-liner for you, unfortunately, but let's talk about it afterwards. Yeah. Okay, it gets even simpler if you specialize this to kind of the canonical AMM. Okay, so there's something known as the XY equal K curve, made popular by Uniswap. Uniswap being the sort of biggest purely on-chain exchange. And if you instantiate this in that case, you get that after you normalize by the value of the assets in the pool, lever, again, normalized by the pool value, is sigma squared over 8. So in particular, the current price of the risky asset doesn't even matter. Your adverse selection costs are sort of accumulating at a particular rate independent of where you are in price space. That's sort of a special symmetry property of the XY equal K curve. And this now is so precise, you can actually make very precise predictions to give advice about this investment decision. Take sigma equal 5% daily. That would be typical for ETH USDC, for example. Take the trading fee to be 0.3%, which is sort of high, but also sort of standard in this part of the world. This tells you you will break even if a little bit more than 10% of the pool's assets trade on a daily basis, okay? If the volume's higher than that, you'll be in the black. If the volume's lower than that, you'll be in the red. Okay, so this decision just boils down to your beliefs about sort of volatility versus volume. Okay, that's what it sort of boils it down to. Okay, so this paper came out August 2022. Not to be immodest, but like literally by the end of 2022, it was the industry standard way that people talked about adverse selection costs in automated market makers, right? So Google knows what it is. There's been podcast series about it. Maybe I'm most proud of the fact we were the #1 DeFi meme of 2023. I'm still trying to figure out how to like list this on my CV in a credible way, but anyways, I'm working about it. 1 minute of reflections and then I'm done, okay? I've been working like full-time in this area kind of 3 or 4 years. In some ways, it reminds me of the early days of algorithmic game theory when honestly none of us knew what we were doing. It certainly reminds me of what we take for granted when we work in a mature field, like algorithms, complexity, even probably ML theory I'd put in this bucket. In a mature field, you have relatively low barriers to entry through textbooks, through MOOCs. And another thing we take for granted is like a research community has solved a hard coordination problem of what are the most fundamental concepts, what words do you use for those fundamental concepts, how do you even measure progress, like what makes one paper an improvement over the previous one. None of these things are the case, sort of working in this area, which can be frustrating, but in my experience, this is also the universe shouting at you that you might actually be in what in hindsight is viewed as a golden era when none of the easy stuff had been done yet. So if that sounds attractive to you, especially grad students in the world, I encourage you to sort of dig into this area more deeply. I'm out of time. I'll put the summary up on the slide, and I'll stop there. Thanks very much.
Okay, thank you, Tim. We have time for a few questions.
I'll let you choose who. No questions? Okay.
So thank you for this talk. What I learned is at the beginning you held out this really fascinating and captivating, exciting concept of the computer in the sky. You then spent the whole talk talking about some of the details of the economics that are going to go under the hood to enable this. Could I ask you to, for the naive person, talk a little bit more about your vision of how this computer in the sky is going to look to the user?
Oh, okay.
Is this going to be like, you use the analogy of the internet, so are they going to be like providers? I sign up for a monthly service from Comcast and I get access to this computer in the sky, or what's the vision of how this is going to look to the user?
Yeah, I mean, so for this to reach its full potential, almost all the users need to not even realize that they're using this technology, for sure. So this should all basically be hidden. So basically, like, my vision is you are downloading apps from the App Store, right? And you're just playing a game or, sending money to your friend, or you're doing whatever. And under the hood, there's some private key sort of in the enclave of your phone, which is signing transactions on your behalf, which then possibly through intermediaries sort of eventually sort of settles sort of on this blockchain protocol. Maybe in the same way that when you go to the supermarket and there's a little kind of certified organic sort of sticker on the food, maybe there's a little sort of secured by Ethereum sort of kind of little part logo on the app that you download. But there's no question, look, like, if you're gonna have 1 billion users, like 99.99% of those users, it needs to be magic. They need to have no idea how it works. So that's also...
How are they paying for it is my question.
Yeah, I mean, what's funny is, here because you have the native cryptocurrencies, actually, there's all the usual ways that could be done plus more, I would say, right? So like, here you actually, under the hood, it's a per transaction payment, right? Under the hood of the internet, there's no per packet payment. Like, that's certainly been proposed many times, but just then you'd have to implement micropayments in the context of like internet routers or who knows what, right? Here it's there, so you have the micropayments if you want them. So certainly, you could imagine sort of subscription kind of series, right? Where sort of like you pay $20 a month, and I'll tell you when you've like used up your budget for like your interactions with the blockchain protocol. Or, you could imagine it's more pay as you go. That's kind of a business model question for, others to figure out. But always, all the options people have now, they will also have for sort of interacting with blockchain protocols.
So there would be businesses built on top of this infrastructure that are then marketing services out to the users of various kinds and pricing them however they decide to.
Yeah, and it could even be just sort of like trivial. It could be literally like, you used to go to Ticketmaster and buy a ticket, and if you wanted to resell the ticket, you had to pay Ticketmaster a 20% fee, and also they could just refuse you if you wanted. 2, here's a new ticketing platform where you actually own your ticket. What does that mean? That means it's stored as digital data on a blockchain like Ethereum. And again, I talked very briefly about blockchain protocols enabling stronger property rights for digital assets. So in particular, I can guarantee you the right to transfer sort of a digital representation of a ticket, and then you can just, in the same way that, back in the day when I'd wake up at 4 in the morning and stand outside Tower Records and actually get a physical ticket, right? No one could stop me from doing anything with that, right? I needed permission to get it in the first place, right? That's an interaction like with an authority. Once I had the physical ticket, I could do whatever I want, okay? Why don't we insist on that sort of same level of ownership of tickets now, right? Once upon a time, there were technological limitations. This technology is lifting those limitations. And hopefully, right, we'll see the business models then sort of, respond accordingly. Yep.
So I have a question about when the switch was made to the posted price mechanism rather than first price auction, and you mentioned that the goal, or if the mechanism is designed properly, we should always be in the posted price regime, and then corner cases might happen. When this was implemented in reality, was it actually the case, or did we see a lot of corner cases in the beginning?
That's a great question. So, in fact, the 2 different hard forks I mentioned interact with each other too. So what happened is first, in 2021, they switched over to EIP 5059, and then in 2022, they switched from proof of work to proof of stake. And this does answer your question. So with proof of work, if you know how it works, you can't control the time between blocks is stochastic, just by the nature of how proof of work works. So you can shoot for 12 seconds, but it might be 4, it might be 20. It's really out of your control. It's just some Poisson random variable. And so when it was still proof of work for that year, you would more frequently see kind of these double full blocks where people had to then compete through tips, because it may just be by chance it took 24 seconds instead of 12 to produce a block. Since the switch to proof of stake, where it's deterministic, so like I think in the proof of work days, maybe it was 80% of the blocks were not full, so 20% you lost truthfulness. In the proof of stake regime, it's more like 90-10. I'm sort of surprised it's as high as 10, to be honest. I don't fully understand why even 10% of the time fail to have the posted price property. But that's last time I checked, which granted was now probably maybe almost 9 months or 12 months ago. That's sort of what it was. So edge case, I may be exaggerating slightly, but certainly the vast majority of the time, you're in the truthfulness regime. Yeah. Great question. Jeff?
I'm still back at the sigma squared, and
Okay.
you'll probably realize by how naive my questions are that I'm not doing cryptocurrencies.
Yeah.
But it seems to have a pretty strong dependence on that sigma
Yes.
parameter.
Absolutely.
And how does that volatility, I mean, there are changes in that volatility, right? Due to geopolitical events, due to all kinds of things. And so in what way might that be destabilizing so that, you don't want to buy your ticket through this, you want to buy it through Ticketmaster, which you have a worse deal, but there's some crazy volatility here.
Okay, yeah, so I'd say a couple of things. I mean, there's going to be lots of digital assets, or at least in my vision for what's going to happen, there's going to be lots of digital assets where there isn't necessarily a lot of volatility, right? There's just stuff, you're selling, like the concert ticket.
There's not a lot of volatility there. Okay.
Here, but so let me get back to your point. I mean, I think you're articulating, I think, a good point. So if your reaction is like, doesn't this seem like pretty high to the point that maybe no one would ever want to do this?
Right, and yet they do. So
they do.
I'm not understanding that.
So
yes.
No, it's not. So you're right. This basically says that if you just look at the first generation of AMMs, the economics is actually not very good for liquidity providers.
Right.
So 2023, that was a huge chunk of and 2024, that's been a huge chunk of the conversation in DeFi. Right, so this work kind of enabled that conversation. Like, we gave them the language to talk about this, and all of a sudden you had all these empirical analyses, basically asking the same question that I don't understand why these people are in this pool at all.
Right.
It's not just that our theory predicts they lose money. You can actually look at the data, and they are losing money, right?
Right.
So, but that said, I mean, you can't. That's not going to continue forever, and so as a result, people who design AMMs are like, let's be more clever. So let me give you an example of the kind of thing that they're doing, right? So then there's a question of like lever mitigation, which has been like a big topic over the past 2 years. So one proposal, which I think is cool, is to auction off the rights to arbitrage. Okay, you can do this at different time scales, right? But basically, like would-be arbitrageurs will compete, okay? And then in effect, like whoever wins,
get rid of the
whoever wins now gets like whitelisted, gets like an ability to kind of be the first person to interact with the AMM each block. And so the point is the competition will make them pay most of their expected profit.
Which will create stability. Yeah.
Exactly. So it gets paid back to the AMM, which they can then redistribute to the LPs.
So it's really again a mechanism design problem.
Exactly.
So that does say it looks like a crazy thing to invest in, but then you say do better mechanism design so that it's not.
Here's the measure you use this is how you measure progress.
Right.
You should be beating this baseline.
You should, and the mechanism design gets, and then there are theorems about, well, does there exist a mechanism?
Exactly.
Which overcomes this? Exactly. That to me sounds like a nice problem. Yeah, I'm sorry.
One open question for other people. Do we have one last question?
It's one of the front ones.
I was wondering, previously I think you mentioned was it liquidity or liquidation entities that they can sort of be countered by well-informed traders, right, with arbitrage. Well, how are those well-informed traders countered then? Is it through policy or is it through how?
Yeah, this is a good question. I mean, a good question is like, what do we want here, right? Like, I think what Jennifer and I were just talking about, I think is not a bad outcome, where in principle all this arbitrage is happening, but most of what would be the profit gets competed back to the protocol and then hopefully back to the people that were causing the losses. There's, in general, a sort of philosophical argument that people have, which is like, is there like almost like a moral obligation that things should be first come, first serve, for example, and like reasonable people disagree about that, right? Because like, I don't know, like Wall Street is first come, first serve, and then you have people investing like hundreds of millions of dollars on like crazy cables to decrease their latency. And so like, do we really merely want to aspire to like replicate kind of like Wall Street on the blockchain, or should we aspire to something better or more egalitarian or what have you? So that's I'd say, yeah. Honestly, so many things in this space, I kind of have like, the more I know about the space, the more sure I am that I don't know what's going to happen. I just am sure that I have like a front row 50-yard line seat, and it's halftime of a really exciting football game, and I just get to watch the rest of it happen. That's kind of my attitude.
That is a good ending. So, thank you.